In this video, I will explore a fundamental thing that we as investors should know, and that is called share buybacks. Hello everyone, it is me Ali, your friendly neighborhood value investor. So let's start off by understanding what is a share buyback. A share buyback is a form of shareholder remuneration where companies buy their own shares to reduce the capital by cancelling the repurchased stock. Easy, right? Let's say there is a stock market crash and the prices of the stocks have nosedived, but the company fundamentals are still strong. So what can the company do? Well, this is where the company can choose to buy back some of its shares. Why would a company want to buy back their shares from the stock market? Well, the simple answer that I can give to you is so that the earnings of the company does not get diluted. Let me try and break it down to you in a story. For example, I'm going to use these toy bricks to represent the earnings of the company. Okay, and let's just say each brick here represents $1, $5 altogether, and these are the earnings of the company. They will have to share their earnings with the shareholders. So let's assume in the company there are 5 shareholders in the stock market, and they have the possibility of getting these earnings because the company is by right having to share with their shareholders. So what will happen is, let's say the company declares that they have $5 in earnings and there are 5 shares in the marketplace. So what is the earning per share? Where simply the earning per share is 1-to-1, or we can say it is $1 earnings per share. So let's assume the company buys off some of the shares from the market and we have this, only 4 shares left. The following year, if the company still earns $5 in earnings, now for each of the shareholders, it'll become 1.2 in earnings. So what the company is essentially trying to do is reduce the number of shares in the stock market so that the earnings are not diluted as much. This is one of the main reasons for share buyback. Is these share buybacks beneficial to the investors? It actually helps the investors, because you see, if there are less people for which to split the earnings with, by doing nothing, the company is actually helping us to earn more money per share that we have put into the company. So what if a company does the opposite, and instead of share buybacks, the company practices share dilution? Well, the answer is simple. Our earnings per share gets diluted, which means possibly less earnings are stipulated for dividends. And an example that we can see where this happens is in a company called Meta. So as a stockholder in Meta, just 2 months ago, I received an email update where the company made some serious changes to their capital. One such instance is an email that I got on the 4th of Jan stating that the purpose of information statement is to inform you of action taken by holders of majority of the voting power of outstanding shares of capital stock of the company to approve an amendment to the company's 2012 equity incentive plan. And that is to increase the number of shares of the company's Class A common stock available for grant and issuance under the public stock plan by 425 million shares effective as of March 2020. So what Mark Zuckerberg, who is the founder and the CEO of the company, effectively he controls 59% of the voting power, and he uses this power to good effect. The letter which I was earlier reading out of, that letter will actually go on to explain that the dilution in shares is to maintain our ability to grant new awards and encourage long-term retention and performance of our employees. You see, for companies to retain good employees or to attract good employees, especially at the C-suite, the higher tiers of employees, what these companies do is they give stock to these employees, and that way the employee is making sure that he does the best job for the company. So Mark Zuckerberg, what he did is that he released some new stock so that he could share these stocks with new employees that he has brought in to his company. And so although there is share dilution, which is quite a normal thing as well, what Mark Zuckerberg hopes is that the people that he shares the stock with will do a good job in the company and help to increase the earnings in the company. Is this a bad thing? Meta has been taking a beating in the stock market recently, over the past year in 2022, it didn't quite perform very well. Mark Zuckerberg has majority control of the company, so investors are just worrying if the stock dilution is being played to good effect or not. Unfortunately, this is something that we cannot tell exactly at that point of time, and we really just have to see that if Mark Zuckerberg divests his shares, that will it be used to good effect or not. And we as investors, really, we just have to trust his plan. So I hope you really liked this video on share buybacks and share dilution. If you want to read up more on this topic, go ahead and Google, find out new things, and if you have questions, write them in the comments below. Before you go, please remember to hit the like button and the subscribe button, and I will see you in our next video. Bye!